Good morning, everyone. Once again, I'm Rose Femia, partner of Balsara Partners, and want to thank you for joining us today. Life insurance, post-mortem planning, and probate planning are very sensitive subjects, and as advisors, our clients turn to us for support and advice. So I hope today's seminar will provide you with some takeaways that will help you to assist in providing that support and advice to your clients. Our speaker today are Tony Gallippi. With an impressive career that spans almost 30 years, Tony's extensive knowledge encompasses investments and insurance with experience ranging from time spent as an advisor to specialist roles, supporting investment insurance advisors in the last 20 years. In collaboration with the client's other advisors, Tony provides advanced sales support through objective industry education, in-depth case consultation, leveraging advanced insurance sales strategies and industry trends to both high net worth and small, medium-sized business owner clients. Our second presenter is Hemal Balsara, who is the Assistant Vice President of Tax, Retirement, and Estate Planning at Manulife Financial in Toronto. He joined Manulife Financial in 2011 after spending 6 years in the tax area of a national accounting firm, where he researched and analyzed complicated technical tax issues, including various tax structuring and estate planning issues, planning for owner-manager situations, and various corporate and personal tax issues. He has contributed to various publications, been a keynote speaker at various industry conferences, and has also obtained his Certified Financial Planner designation. And lastly, our third speaker is Joe Figliomeni. Joe is a tax partner at Balsara Partners. Along with his CPA designation, Joe completed CPA Canada's in-depth tax course and is currently pursuing a trust and estate practitioner designation with the Society of Trust and Estate Practitioners Canada. Joe is the lead on tax articles published by a firm to keep clients up to date on the latest tax issues, and has also contributed to publications by the Canadian Tax Foundation. He also has participated as a panelist on various tax seminars, including the firm's annual tax update and the City of Toronto COVID Stimulus Advisory Committee accounting panel. So without further ado, I will pass the floor on to Tony Gallippi for his presentation about life insurance as an asset class.
Well, once again, thank you very much, everyone, for joining us on today's presentation, and thank you to Rose and the partners at Balsara for including myself and Hemal in today's presentation. As Rose mentioned, the first segment of today's presentation is on life insurance as an asset class. My name is Tony Gallippi. I've been in the industry, as Rose mentioned, for just slightly 30 years right now, and I work closely with independent financial advisors to help identify and develop large case insurance opportunities with their high net worth clients. This segment of the presentation will focus on permanent life insurance as an asset class. Now, when many people think of life insurance, many people think of it as an effective risk management tool. And that's pretty much a majority of the scenarios that we do find ourselves in. But what that usually does is it helps, it actually promotes the myth that the wealthier individual gets, the more assets that they accumulate, the less likely they're going to need or even want life insurance. Now, that can't be further from the truth. We notice in the industry that some of the biggest purchasers of life insurance are the high net worth wealthy clients. But the reasons for their purchasing of life insurance are much different from, let's say, the traditional family market. So today's presentation is going to look at exploring some of the more common and popular corporate strategies that evolve from this notion of permanent life insurance as an asset class. And we're going to uncover those and see as to why high net worth clients actually gravitate to those strategies. But before we do that, what I'm going to do is I'm going to spend some time just basically going over why do people purchase life insurance to begin with. Now, this generally falls into three categories, and these are the three categories that we find. There's a need to create an estate, there's a preservation of estate, and a maximization of estate. These are generally the categories that we find life insurance actually fits into. I'm going to drill down to each one of these particular categories, and what you're going to notice as we move down the list, the intention or the spirit behind the purchase of that insurance product moves from what's called a need, where the client actually needs the insurance, to more of a want. We move into more of from a risk management perspective, to more of a looking at insurance as an investment. So you'll notice that as we drill down to each one of these categories. So when we look at the estate creation is for those clients who consider their number one asset is their ability to earn an income. These are clients that have very little in the form of assets in their balance sheet. And they're concerned that in the event of a premature death, is that they need to support their family, that they need an instant infusion of cash to be able to support their family during that time. Now, the only way for them to do that is to purchase life insurance because it gives them that instant infusion of cash to help support their family, for the remaining years of their dependency. So for these individuals, they're looking at protecting what's called human capital. Now, human capital is defined as one's future earning income potential. And as we noticed, the further you're from your retirement years, the larger that human capital is because you have more years of potentially earning income. As we approach, close to retirement, there's less years of working, therefore there's less income to protect. So for these individuals, life insurance really replaces a needed stream of income lost in the event of a premature death. So when it comes to life insurance purchases here, it's usually a need that term insurance is needed to help protect your human capital and replace your income in the event of a death before retirement. In a corporate setting, we find that the insurance is needed to fund or to facilitate the funding of a buy-sell agreement amongst partners, as well as to provide an infusion of cash to the business to support the business in the event of a loss of a key individual. So that's where the human capital aspect protection comes in the first phase of creating an instant estate, which life insurance can do. Now we move on to the second category. The second category of where we find life insurance is purchased is to preserve an estate. Now, this is basically for clients that have actually been successful in amassing a great deal of wealth over the course of their lifetime. And they understand the impact that taxes will have on their ability to transfer that wealth intact to the next generation. So they're looking for ways to minimize the impact of taxes that have on the time of transfer. And generally, what we find and they find is that life insurance or permanent life insurance can actually be considered one of the most cost-effective solutions to address that eventual tax bill that they're going to face. In this particular category, individuals are looking at protecting their financial capital. And when I mention the word amass a significant amount of wealth, this is a relative term that I use in the sense that these are individuals that whatever wealth they've generated, they're never going to outlive that money. So it's all relative depending on someone's particular station in life. So to illustrate this example of life insurance as an estate preservation tool, to minimize the impact of taxes, I have kind of a case study here or an example that I've used before. And this is for, say, a family that has a family cottage that they'd like to keep in the family beyond the passing of both husband and wife. Now, through calculations that we've done, we've determined that the eventual tax bill in year 30 of that cottage property is going to be roughly around $265,000 through the calculations that we put forth. Now, there's generally four different alternatives for them to tackle this issue. They can either have the estate borrow funds in order to pay the tax bill. They can either sell assets, other assets that they have, liquidate those assets and actually use that towards paying for the tax bill, or they can actually put together a savings program today and start accumulating enough to actually get to the point where they can pay the tax bill, or they consider life insurance. When we stack all these four options together, we see, given their specific age and the product available for their particular age group, life insurance is the cheapest when it comes to addressing that particular issue. So what a lot of people like to say is for pennies on the dollar, that issue of addressing the tax bill can be addressed. And when you look at the four options available, you can see that how we come to the conclusion that life insurance or permanent life insurance can be considered the most cost-effective option to solve that particular problem. So now we'll move on to the third category of where most insurance purchases fall into. And this is once again dealing with the wealthy clients, those who have been successful in amassing a great deal of wealth in the course of their lifetime. This one's referred to as estate maximization. And the estate maximization, these are for clients that have determined or have identified specific assets within their balance sheet that are not needed to support their lifestyle goals or are not needed to go back into their businesses. And what they're looking at simply is transferring some of these assets that are taxable into a tax preferred permanent life insurance plan. And to take advantage of one is minimizing taxes during the accumulation phase of their investment and also maximizing estate values. So basically what this entails is transferring a portion of those taxable investments into a tax efficient permanent life insurance. Now for clients that objectives might require that they need liquidity during their lifetime, they can actually design these permanent life insurance plans to include a cash value component that they can access tax efficiently during their lifetime. And I think Hemel's going to get into a bit more of that discussion of how to leverage against your policy. So we have three categories that we touched upon here. We have estate creation, estate preservation, and estate maximization. The estate preservation and the maximization more deal with protecting one's financial capital. So in this area of financial capital, life insurance helps protect the value of one's net worth from taxes and market risk. So not only is it to fund tax liabilities, but also, as you're going to see, and you're going to see later on in my presentation, you're going to see how it allows you to actually transfer assets tax effectively from the corporation to the estate. Especially in a corporate setting, what you're going to see from some of the corporate insurance strategies that I'm going to talk about later on is permanent life insurance can significantly increase the after-tax transfer of wealth to the beneficiaries. Also, in certain settings, permanent life insurance could be looked at as an alternative asset class for safe money, depending on the plan design chosen. So now we're just going to quickly highlight why is it permanent life insurance considered a separate asset class for many, especially the wealthier clients, because intrinsically, the way the product is designed, it helps to minimize taxes during the accumulation phase. It also helps to minimize taxes during the distribution phase. As we know, life insurance is paid out tax-free. In a corporate setting, it has the advantage of extracting money through the capital dividend account that allows for the tax-free transfer from corporation to estate. And also, it can actually be designed to be able to help preserve and improve liquidity for clients that are looking at accessing cash during their lifetime. So it's not only a death benefit for the next generation, it actually can help preserve and improve liquidity for the individual that they can access while they're alive. Depending on how you structure the plans, because there are different types of permanent life insurance plans, you can have access to unique high-yielding private fixed income investments that are not usually available to retail investors. And also, once again, really depending on how you design the plans, some plans are structured differently than others. On the permanent life insurance side, they can actually be considered a great alternative to traditional fixed income investments. So this now moves us, now we're going to move and focus our attention on the strategies that are very popular in the marketplace that basically evolve from this notion of permanent life insurance as an asset class. Now, the top strategies that are currently in the marketplace that we find are getting the most attention and most high net worth clients gravitate to are called the corporate estate bond, as well as the corporate insured retirement program. These two strategies are probably the most widely talked about corporate strategies in the marketplace, as well as widely implemented. And they actually generate, are responsible for some of the largest premium dollars in the industry. And it's basically these two concepts here. So aside from taking you through the basic fundamentals of how these strategies work and who they're designed for, I'm also going to share with you some language that you as a tax specialist can actually incorporate in your discussions with your corporate clients to help determine and gauge interest in the concepts, as well as to determine if these clients could be ideal for these particular strategies. But before I do that, what I'd like to do is just spend some time actually giving you the background, giving you the lay of the land as to why these strategies have become so popular, especially in the last few years. And I think a big reason for this is actually given the work that you've done as tax specialists, as well as any lawyers on the calls. What we've noticed in the industry over the last 15 years is a lot of business owner clients have been encouraged to keep surplus capital that their businesses are generating. And how we define surplus capital is capital that's not needed to support one's current lifestyle goals or is not required to go back into the business for business operation. They've been encouraged to keep that surplus capital invested in the corporation as opposed to paying themselves personally and investing on a personal level. And the reason for this, and why is this surplus capital retained in the corporation in the first place, comes down to one simple fact. It's simply the difference in tax rates that an individual shareholder has on a personal level versus what their corporation pays on the corporate level. And to illustrate this point further, use the example of the province of Ontario. The highest marginal tax rate for a shareholder in Ontario is currently at 53.3%. That same shareholder, any active business income that their corporation earns, up to $500,000, as you know, is already taxed at 12.2%. therein lies a significant tax deferral opportunity. So just roughly said, it's about 40% tax deferral opportunity. Said differently, as you know, for every $100 that the corporation earned, they can defer up to about close to $40 in taxes. Now, the saying goes, the more we're able to defer, the longer we're able to defer it for, the larger bucket of money we're able to create for ourselves or for the next generation. So that's why we see a large amount of surplus retained in the corporation, and therein lies the opportunity to explore different strategies on how to make sure that money grows even that much further. So one of the challenges actually, or one of the issues that have actually expanded this notion of building or increasing surplus capital within the corporation is also some of the changes made in the tax rules back in 2008. As you being in the industry would know better than we do, the tax on split income was, there's corporations and business owners that have structured their affairs through estate freezes and introducing family members as shareholders of the corporation to help do what's called income splitting. And the income splitting allowed them to lower the overall tax bill of the family as a unit. But back in 2008, there were some significant changes to the tax on split income that made it slightly more difficult for business owners to do that. What it meant, it pretty much kept more money trapped in the corporation, therefore more of an opportunity or more to look at some of these strategies that can help alleviate some of these tax concerns that are in the corporate setting. So assuming that the business owner clients has seen the benefit of actually leaving surplus capital within the corporation, the next challenge they generally face, as you're well aware of, is those assets are now classified as passive assets. And as we know, any income earned on passive assets are taxed at the much higher rate of 50.17%. So the challenge for those business owners is to look at ways or opportunities or strategies that can help alleviate or eliminate or at least reduce the impact of this tax bill on their passive assets. And as you'll notice later on, given the attributes of permanent life insurance, you can see at how to minimize the impact of this particular tax bill on those investment assets. One of the changes that have actually shed more light or put more light on this problem were some of the introductions to the new rules on the passive income tax rules. As U.S. tax practitioners are well aware of, the more passive income a corporation makes in a corporate setting, the more it can actually erode their access to the small business tax rate, therefore putting more emphasis on clients to look at ways to help, have their investments grow, but not have those investments taxable, therefore putting some of that pressure on the small business tax rate availability. So one of the challenges that these people are facing is how to avoid having to pay this tax. And as you'll see later on, the permanent life insurance offers a great solution to do that. So, and the last hurdle that we're going to look at is for those individuals that have had that trapped surplus within the corporation, that eventually they're going to want to extract that money and have it transferred over to the next generation. And they're going to be looking at ways of doing that tax efficiently. And we'll explore some of the ways that life insurance helps to do that. So where do we normally find this money as people on our side of the industry? We normally see that this money is held in a holding company. And once again, I think a lot of this comes down to your work, and whether it's CPAs or lawyers have instructed clients properly that have the opportunity to set up these holding companies for various reasons. One is to provide creditor protection from those passive assets from any potential lawsuits that might happen on the operating company level, and also gives an opportunity to separate those personal funds from the operating level, especially if there's partners involved and each of them have access to some of the surplus capital. Having it housed in their own personal holdcos allows them the opportunity to dictate how those funds are going to be invested. And also, it does provide an opportunity for purification of the opco to set it up for qualification of the capital gains exemption. And that gets into a whole other category, as we all know, of corporate reorganization structures. So that's generally where we find some of the surplus capital. So just to recap as to why some of these strategies have really garnered interest in the last few years, we're finding surplus income is retained in the corporation. There becomes that issue of how to address the passive income tax problem and where do we find that surplus. And that basically brings us to the two most common strategies on the insurance side that we find a lot of high net worth clients have been gravitating to for the reasons of what it allowed for addressing some of these concerns. And the first one is called the corporate estate bond concept. Depending on the company that you're dealing with, they have different classifications. Some may refer to it as a corporate investment strategy or a corporate asset transfer plan. The predominant name in the industry is the corporate estate bond. They're all the same thing. Basically, the strategy is a corporate insurance concept. It's designed to increase the after-tax value of the corporation for the heirs. The way this is done, it's transferring a portion of the taxable investment that's currently being exposed to annual taxation within the corporation into a tax-efficient policy. By doing this, you're able to reduce and minimize the corporate taxes on an annual basis. Also, upon the eventual distribution of those assets, you're able to minimize some of the deferred gains or eliminate them completely. And by virtue of the first two, as well as also by the advent of the capital dividend account within the corporate setting, you're able to maximize estate values as you're able to transfer those assets tax efficiently from the corporation to the estate. So the corporate estate bond, in a nutshell, it's a permanent life insurance which provides tremendous opportunity to convert these assets tax efficiently to the estate. Now, the objective of the client is, for one, is providing life insurance protection. Now, for the most part, what we notice when clients are in this kind of situation where they've identified assets within their corporate setting that are not needed to support their lifestyle goals or to go back into the business, really the initial motivation is not to provide insurance protection, but these clients are simply looking at redirecting some of those assets, whether it's on a periodic basis or slowly melting down a certain like investment account. So whether they're usually having that drive the life insurance conversation, but generally you have to establish a need for life insurance in order to enter into this discussion. And what one of their main objective is to increase the after-tax rate of return on those particular deposits. And the way they go about doing this is by transferring those investable assets that are currently taxable, as I mentioned earlier on, into a tax-preferred life insurance plan. And depending on how you design that particular life insurance, you can actually help alleviate some of the capital gains pain that client might find in the eventual on the eventual passing. Hemal is going to also discuss some of the post-mortem planning strategies that are available to address some of these issues of double taxation. But there's also ways to design the particular plan to be able to alleviate some of that capital gains issue as well. So who are the typical clients for this? It's owners of a privately controlled corporation. Usually we find them between the ages of 50 and 70 that require permanent life insurance. And the reason why I say between the ages of 50 and 70, by this time, usually they've entered into a mature stage of their business cycle where, they're into a phase where they've actually accumulated surplus capital. They can start to actually separate and say, this is assets that I know it's not required for my lifestyle or not required for business operations, and I can safely say it's something for the next generation. So this is usually in the mature phase of their business cycle. These are clients generally of good health and are able to qualify for insurance. As mentioned, it's important for them to have surplus cash flow for us to work with, and they're not required for the day-to-day operations nor for their lifestyle. And their intention is to pass on wealth tax efficiently to the next generation. So to unlock some of that surplus capital that's currently being taxed in the corporation tax efficiently to the next generation. And they're also interested in a tax-deferred flexible investment option to minimize taxes in the event that they want access to their money during their lifetime. Now, you as a tax specialist, if you're part of your day-to-day conversations with your business owner clients, the way you can identify some of these clients, if you choose to, is you can ask a series of questions that can help you in that discussion process. And this is just a list; it's not an exhaustive list, but it's something that you can keep for your own references later on as to how you want to approach this, engage your business owners to see whether or not they're ideal for these types of strategies. And these are just some sample questions that you can incorporate in your discussion. But um, one of the major ones is, do you have surplus capital that you don't need? Do you want to reduce your corporate taxes on your investment income? One of the ones that I like is further down on the list is something that you've helped to create as an accountant is, and this is something we use on our side, is that we say, Holdco, why did your accountant initially suggest to set up a holdco? I'm here to complete what your accountant initially started. So the initial purpose of setting up the holdco is to separate some of those assets from the operating level, but the next stage is to really see how to make them grow tax efficiently for your benefit as well as the benefit of the next generation. And here's just another list of questions that you can incorporate in your discussions with your business owner clients. So to illustrate this concept a little further, I put together a case study here to help you see the significant difference of moving from a taxable type of investment that's in the corporation to a tax-preferred permanent life insurance. And here we have the example of a male and female. So it's a business owner client. They're both age 55 years old. They own the corporation and they have $60,000 that they're on an annual. Well, they're creating surplus capital within their corporation, but they can designate up to $60,000 per year for a period of about 10 years. So they have the option of either investing this in traditional investments or purchasing a permanent life insurance. They're ideal clients because they've identified these assets or this surplus capital is not going to be required for themselves or to be required to go back into the business. So they have the option of either investing those assets and watching them grow, but being exposed to annual taxation and therefore eroding the value of those assets as further, or buying permanent life insurance with them. So the first rule we notice is that they can invest those, they can put that $60,000 investment into a traditional investment. And as we can see, although they have access to investment value through withdrawals, we can see as we project it way out into the future, and we're looking at a 30-year span here to life expectancy, the actual market value after annual taxation is worth about $876,000. In the event of death, their holdco will be wound up. A taxable dividend would be attributed to the estate, which is roughly just over $1 million, resulting in an after-tax estate value. And you can see it's highlighted in yellow on the right side of $547,000. The after-tax internal rate of return is actually a negative 0.36%. Now we look at the other option is they can deploy those funds into a permanent life insurance plan. And in this also, as the plan continues to grow, it is not exposed to tax as long as it stays within the limits that are prescribed by each policy. They're able to grow those funds tax deferred, and they have access to those funds during their lifetime if they choose to. And some ways to access that money are more tax efficient than others, but it's beyond the scope of today's presentation. We project this out 30 years into the future. We can see that the total death benefit at that point is $1.8 million. That actually credits a capital dividend account of just under $1.6 million, and a portion of that death benefit that is still taxable is $270,000. So we can see an after-tax value to the estate of $1.7 million, roughly increasing the estate value by $1.2 million by simply redeploying some of those funds from an investment account into a permanent life insurance plan. And that results in an after-tax internal rate of return of roughly 4.2%. So a significant advantage in favor of the permanent life insurance plan. As you can see that it really goes towards increasing the after-tax transfer of wealth to the heirs. So the next popular strategy that's out there in the market that a lot of high net worth clients gravitate to is called the corporate insurance retirement plan. Now, this particular plan is basically an extension of the first plan. The only difference in here is that aside from providing insurance protection either for the business or for the estate, maybe it's to alleviate tax liabilities, the client's other focus or other objective is to accumulate wealth that they can access during their lifetime tax efficiently. So there's a dual objective. One is to provide life insurance protection, maybe to address tax liabilities, also to accumulate wealth that they can access during their lifetime. So the solution basically is transferring, once again, a portion of some of those investable assets that are trapped in the corporation, but to also provide like an accumulation of wealth that they can actually access tax efficiently during their lifetime. So the corporate-owned life insurance held until death, tailored or designed in a way to maximize cash values, while at the same time providing protection needs for the estate. So the way it works, or the objectives of the plan, are the corporation puts in place the much needed valuable life insurance. And for the most part, a lot of these, what we see is the business owner are looking to purchase life insurance to address some of those tax liabilities that their estate's going to face in the event of their death. The deposits that go into the plan, they grow tax deferred, therefore reducing the overall corporate tax bill. If we project 10, 15, 20 years into the future, as those policy values continue to grow, those values can actually be used as collateral to access funds without triggering any tax. Fast forward much further into the future, when the individual business owner dies, the death benefit can be paid tax-free to the corporations to the estate for amounts that are above the adjusted cost base of the policy. And what you'll notice with these policies, the closer you get to life expectancy, the more of the death benefit gets paid out tax-free. Now, who's the target market for this particular strategy? We're looking at small business owners who require and are able to qualify for life insurance protection. Also, business owners who would like to transfer some of their current investable assets that are taxable on an annual basis, which are considered passive assets, into a more tax-preferred insurance policy. These are also for business owners who are looking for a source of additional cash that they can actually sprinkle to their shareholders during their lifetime tax efficiently, or maybe for purposes of business expansion. And these are also for business owners who can qualify for third-party loans or able to manage these loans as part of their business operation. So some of the questions, once again, as you as tax practitioners, or for the lawyers on the call, if you want to engage your clients to determine whether or not these are strategies that they can actually benefit from, there's some of the questions that you can actually incorporate in your discussions with the client. Are you accumulating an investment portfolio within the corporation? If so, are you doing this for the purposes of retirement planning? The answer is yes to that. They may want to look at an alternative strategy that can help them to do that more tax efficiently, which I've shown you through the corporate insured retirement plan. Are you healthy between the ages of 45 and 65? Do you want to supplement your retirement income? These are just a snapshot of various questions you can incorporate, but it's for something that you can decide as to what level of engagement you as a tax practitioner and a lawyer would like to have with your client to help them to achieve some of these optimal goals within their overall financial plan. Some additional questions, but I'll just leave this to you as that you can reference later on. But that concludes my part of the presentation as to why we consider permanent life insurance as an asset class, and some of the strategies that a lot of the high net worth clients gravitate to that really expand on that notion as permanent life insurance as an asset class. So I thank you once again, and I'm going to pass this over to Hemal to take us through the next segment of the presentation. Thank you very much.
Great, thanks, Tony. Great to be chatting with everybody today. In terms of the content that I'm working through right now, there's really two main aspects to my subject matter. The first is basically leveraged life insurance, immediate leveraged life insurance, which involves purchasing a policy today and then borrowing the money out right away, which is a sister concept to the concept that Tony spoke about earlier, the corporate insured retirement program, but this is more immediate in nature, and we're seeing a greater proliferation of these types of deals. And we figured that it would be timely for those on the call to actually see what this is all about. And then what I'm going to be touching on is post-mortem planning. So in a nutshell, normally I would spend about an hour talking about each of these topics independently. And in your package, you've got about 65 slides that are provided to you. What I've done is I've pared this down in terms of today's discussion. And if you do have follow-up questions, don't hesitate to reach out. And the other thing too is if you're interested in learning about more insurance news as well, in terms of how insurance fits in from a tax estate planning perspective, I've also I typically normally post things on LinkedIn as it relates to articles from our team. So anyways, with that, let's jump into the details. So in terms of the basics, immediate leveraging, what is it? Effectively, the immediate leveraging, we call it an IFA, an immediate finance arrangement in the insurance world. So basically what happens is if you ever hear a client talking about an IFA or an IFA, basically that just means they're going to be purchasing life insurance, a permanent life insurance policy. And what they're going to be doing is they're going to be turning around and leveraging that policy immediately. And what happens is what drives this idea or concept is we're basically taking those borrowed funds, and what we're doing is we're turning around and investing that money. And what this does is it creates a few different sets of deductions along the way. The first is interest deductibility, because what we're doing is we're using the borrowed funds for an income generating purpose. But then the second thing is we can actually create a collateral insurance deduction. And with the collateral insurance deduction, you don't get to write off the entire amount of the premium, but you can write off a small portion of the premium. And the way it works is basically the financial institution requires the life insurance policy as collateral security for the loan. And what happens is because of that requirement, what we're able to do is basically qualify for the purposes of the rules under the cloud insurance deduction rules. And basically what we're able to do is unlock a series of deductions in the process. The other thing I wanted to highlight is this is a collateral assignment, so it's not considered a disposition of the policy from a tax perspective. So what happens with that is that's a good thing, because effectively what we're able to do is effectively unlock the equity of the policy. So it's almost like a reverse mortgage against the cash surrender value of the policy. So effectively the way this thing works is the client buys a policy and creates significant cash values in the early years. And that policy is assigned to the bank as collateral for a line of credit. And then what happens is the client pays the premiums on an annual basis. And the client can borrow back up to 100% of the cash value, or you could even borrow back more if you provide additional collateral security to the financial institution. And basically the client uses these funds for investment purposes, operating businesses, real estate, non-registered investments. And basically these steps are repeated on an annual basis. What happens when the client dies is effectively the death benefit goes to two places. So first off, it goes to the bank to repay the loan, and the residual amount goes to the beneficiaries. And what happens here is where we have this done in a corporation. What we're able to do is create extra CDA. And I'll just give you a simple example. Let's just say, for example, we had a $5 million death benefit in a corporation with a policy with a zero adjusted cost basis, and we had a $4 million death benefit. What would end up happening is the corporation would receive $1 million, the bank would receive $4 million, but the CDA credit that was created by the life insurance policy would still be $5 million. So effectively, we've got $5 million of CDA, $1 million of cash. So we basically have $4 million of extra CDA. And that extra CDA can be powerful in terms of unlocking other taxable retained earnings or taxable surplus within the corporation. So what we're effectively able to do is strip out $4 million of extra retained earnings. And when we combine this with some of the post-mortem planning strategies I'm going to discuss later, it can be a very, very powerful tool to lower effective tax rates at the time of death. So as we talked about, the benefits of this thing, it includes the life insurance protection today, it preserves our cash flow, cash values, as Tony alluded to, grow tax deferred. What we're able to do is get a portion of the insurance premiums and all of the loan interest. It's potentially tax deductible if we use it for investment purposes. The loan repayment can be deferred until death. And what happens is there's flexibility on the timing of these loans. They're often illustrated over a certain period of time, but you can actually vary from that game plan. And last but not least, the holy grail of all tax attributes, this structure creates CDA and the ability to create excess CDA. So, your next question for me is tell me a little bit more about this. Who does this, right? And effectively, the average deal size has been about $2 million. So that means about $200,000 of premium over 10 years. And 65% of them are basically corporate owned, and about 35% are personal. And what happens is the largest case ever was about 41 million bucks. The smaller cases are about 300 grand. Typically, you don't want to see 300 grand. So that's 30 grand over 10 years, just because the costs to set this up are pretty high. We're typically seeing this done with business owners, some with senior executives and professionals, about 28% of all deals, and then only 5% from regular corporate people and regular workers and trades. The average age is about 50, where we use joint last die life insurance. Joint last die is where we basically insure two people, often a husband and wife, or a couple of spouses. It's basically the average age is 55. So, I've got 3 examples in the slide decks that you have. I'm only going to walk you through one in terms of where the fit is. The reality is in terms of fit, you always have to look at this concept from the lens of 2 perspectives. The first perspective being the lens of whether things flow from a tax perspective. And then the other lens that you want to look at it from is from the lens of banking, because what happens with this concept is the insurance gets underwritten separately from the bank loan. And what happens with this is because you're separately underwritten for both of them, you got to be a fit from an insurance perspective, be healthy enough, have that insurance need to qualify. And then in terms of the banking side, you actually have to qualify through the banking standards for this. And each of those are independent processes that a client would have to work through in terms of this. This example here is like a slam dunk on both sides, but I'm going to walk you through it anyway as to what would be a slam dunk candidate. The first is we have Mrs. Stock Market, extremely successful investor, averaging 15% returns on the markets. And the reality is for her, she finds life insurance returns good, but they're kind of low. Just as a point of reference, Tony alluded to the corporate estate bond strategy and the corporate insured retirement program. Usually with those strategies and even immediate leveraging, we typically use whole life, and whole life right now is returning about 6% on the policy. When you got somebody who's doing 15% return on markets, the 6% may not be attractive like Mrs. Stock Market found. And she has about $40 million of trapped surplus retained earnings within the business. And she's got a mixture of interest, portfolio, dividend income, both US and Canadian, and some capital gains mixed in. And why would this work for her from a tax perspective? This allows her to have insurance coverage today and deploy her capital elsewhere, because she's basically putting the money into the policy and then she's leveraging it back out. So she gets the benefit of not only having the insurance policy that's growing, she can continue her investment strategy, and her loan rate is going to be lower than the growth rate of both the insurance policy and the asset that she's investing in. So she's basically making her pie bigger. The deduction should occur at high tax rates. There's a positive correlation between tax rates and the internal rates of return on this thing. Basically, in her case, she's likely going to be earning investment income at 50.17%. So she'll be able to soak up the deductions at 50.17, which is the tax rate on investment income. And then CDA can be used to strip out taxable surplus tax effectively. Because for her, this is really what made it hum. And basically what happens with her situation is now, if we come back to that numerical example where we talked about, where we had a $5 million death benefit, $4 million loan, and zero ACB on that policy, what would happen is she would get $1 million of cash in the corporation net of receiving everything, and she would actually get a CDA credit based on the $5 million value. So she's basically created $4 million of excess CDA. So at the end of the day, this becomes very powerful for her, because now she could create excess CDA that she could use to strip out other monies and combine with post-mortem planning to minimize double tax. In terms of the other consideration here is you want to do this strategy in a corporation you know you're never going to sell. And the reason for that, and this is the case with any permanent life insurance policy, because at the end of the day, if you do sell your business, you're going to have to transfer the shares out. So in this case, Holdco is never going to be sold, right? The other thing here is from a considerations perspective, if her income mix swings to more of a capital gains, more capital gains as opposed to more regular investment income, what's going to happen is she's going to need more income to soak up the deductions. The other thing I wanted to highlight here really quickly is just look at the top left-hand box, which is the corporate tax rate, 50.17 and 26.5. And there's a lot of details here, but look at the last box at the bottom, which is basically the IRR at life expectancy. What happens is the higher the tax rate, the higher our internal rates of return on this thing. And the reason for that is basically there's a positive correlation between tax rates and the deductions created. So on the other side of the puzzle, from a banking perspective, why would Mrs. Stock Market be a fit? Well, she has a history of steady cash flows. She could support the debt obligation. Pledging of additional collateral security is easy with the existing portfolio. And the bank highly values her tangible net worth of the company. They're still, from a considerations perspective, they're still going to have to look at her ratios from a debt service coverage ratio, and then also the total debt service ratio as well. So that's always a macro consideration when working with this. But generally speaking, Mrs. Stock Market would be an amazing fit. So let's actually look at a case study of how the numbers would actually play out. So we're switching up the case facts, and we're looking at Joe, a 60-year-old who's married with 2 adult children. He owns a car dealership, froze his shares a number of years ago, and currently he has $40 million of preferred shares with a nominal ACB and paid up capital, and he needs about $10 million of coverage to fund his final tax liability. And Holdco has excess cash, but has earmarked that money for a new building, and Holdco's tax and investment income tax rates. So what he was presented was Joe needed about $10 million of initial coverage. So one of the options that was presented to him was a joint last die policy with him and his wife. His wife is 60, he's 61, his wife is 59. And what happened was, we looked at Holdco, and the initial death benefit was going to be $10.9 million, paying about a $733,000 premium. And Joe really needed the money to build the building, and the IRR of 5.34% at life expectancy really wasn't that impressive to him. In a nutshell, what the issue was basically having the capital tied up in the life insurance really wasn't going to, do what he needed to do from reinvesting in the business. So what we looked at was the advisor actually ended up suggesting possibly doing an IFA, or immediate finance arrangement. And with this, with the IFA, there's basically 3 main structures of doing this, where we're either just leveraging the cash surrender values. And with this one, we're seeing about 35% of all deals being this iteration. The second one is where the client replaces the premium and pays interest. And we're seeing about half of the deals coming from this place. And then the third way of structuring is the client replaces basically the premium and borrows back the interest after paying it out of pocket. There's a tax cycle that we go through to ensure that there's deductibility under 21C. So what ended up happening was they basically suggested the idea, let's look at the IFA. And in this case, there's a few different, for those of you who haven't seen this table, there's a lot of numbers here, but the numbers that you want to focus on are the ones that I've put in squares. So basically, we've got a 12.99% return after tax. So basically, assuming we're in a 50.17% tax rate environment, that's basically almost the equivalent of about a 26% rate of return. The other thing is this benefit doesn't include, this is just cash on cash returns within the corporation. This doesn't include the benefit of the CDA either. So we're actually creating a huge CDA credit as part of this process. So if we look at this, In year one, we're putting in 733 grand. This is going to create a cash value of $503,000 and a CDA. It creates an initial death benefit of $10.8 million, and we get a CDA credit of 10.1. And what happens is we have a loan balance of about $503,000 at the end of year one. By year 10, we would have put in 733 grand for 10 years. Our loan grows to about $8.4 million at that point, just because the interest is growing in terms of the loan. And if we take this out to life expectancy, what ends up happening is we get a death benefit of 30. So that's year 32. We get a life death benefit of basically $30.97 million, so almost $31 million. And we get a CDA credit of $29 million, and we have an outstanding loan balance of 14.6. So effectively what we're able to do is create $14.4 million of extra CDA that we can use to strip out other monies from the corporation. So this becomes a very, very powerful tool. So in a nutshell, in summary, if we look at this, by life expectancy, year 32, we've got an internal rate of return of about 13%. This was an amazing return for the client. There's actually an outflow of cash for the first 5 years. And then what happens is the way the cash values were growing in this policy, what we're looking at is basically cash inflow. So we're actually able to borrow more than what we're paying as the premium for years 6 to 10. And then after that, we basically got zero cash flow. We're not pledging any additional collateral security. And then what happens is from a tax cycle perspective, the interest is serviced monthly. And then at the end of the year, it's lent back net of taxes. And the other thing to look out for with immediate leveraging is the income required to use the deduction. So, the highest income required to use the deduction was in year 32, which is about $748,000. And this is important because at the end of the day, as it relates to deductions, if you don't have the income to soak up the deductions, you won't be able to, your internal rates of return start dropping. So anyways, long story short, this was actually one of those options that the client considered and ultimately went with in this situation. I've got a couple of other examples of how it works. The tables are all in your slides, but yeah, let's jump into the next slide. So we talked about this concept, and the reality is there's a bunch of different considerations. Like, I made it sound very simple, but this is meant to be a high level synopsis. But basically, the loan isn't guaranteed. You actually have to go through financial underwriting. The rates, both the interest rates on the loan and the rate of return on the policy aren't guaranteed either. So this is very important from a macro perspective. In terms of structuring the policy, what you have to do is you have to work with a good advisor to figure out the best structure for your client. And when I say advisor, I'm talking about your financial advisor, insurance advisor who works in this space. We want to have in terms of unwinding this thing, it can be potentially complex because especially if the goal is to, the loan part is easy in terms of if we're using the borrowed funds to invest, we could always sell the asset we invested in to repay the loan. But if we try to surrender the policy, there can be policy gains created, and there can be potential income tax implications associated with that. And the other thing to consider with this is generally speaking, with any long-term idea, and this is any long-term planning, you have to consider the potential impact of legislative changes. That's an inherent risk of doing any planning, anything from an estate freeze all the way up. And then with respect to GAR, there haven't been any GAR cases as it relates to the IFA specifically. So, but we always just bring that to the table. And then lastly, U.S. persons. With respect to U.S. persons, they're the proverbial. I kind of call it like, you get a can of soda, you shake it, you open it up, and it makes a mess. As it relates to U.S. estate planning in general for Canadians, what happens is when we have U.S. persons, it makes life tremendously complicated, as the U.S. tax rules are different than Canadian tax rules. Things like CDA can be taxable to U.S. people, so we'd have to evaluate the situation as it relates to U.S. persons. So we're going to switch gears. We talked about the IFA concept, and we're going to actually talk about postmortem planning. And again, like the IFA section, I've kind of distilled what I would call the macro ideas. And in a nutshell, postmortem planning, I find has been consistently one of the hotter topics talked about at estate planning conferences, probably for the last decade now. And the reason for that is it's just so punitive. And as you can appreciate, postmortem planning is really an idea that arises because what happens when somebody passes this away is they actually have a disposition of their private company shares, and that creates capital gains taxes. But the reality is if no other planning is done, and the beneficiaries of the estate ultimately want to strip out money from the corporation at a future date, there's going to be corporate tax to sell the investments, and there's going to be dividend tax to cycle the money out of the corporation. So there ends up being 3 layers of tax that can significantly erode the value of an estate, and that could be extremely, extremely punitive for a client. So let's just look at a simple investment company example. We have Mr. A owning 100% of Invesco. Basically, Invesco was created from the proceeds of the sale of a business. They did an asset sale. And what they're going to look at doing is putting $100,000 a year for 10 years into a portfolio, earning the rates of return highlighted on the slide. What happens is Mr. A, immediately before death, is going to have a fair market value of $7.33 million. We're assuming that there's $5 million of other assets with full basis, so almost like a GIC. And what's going to happen here is basically the ACB and the puck of those shares is going to be nominal. The investment portfolio in the underlying corporation is going to have a fair market value of $7.3 million. It's going to have an ACB of 6.7. There's going to be some RDTOH and there's some CDA. So if we assume tax rates of 47% on ineligible dividends, 53% for other interest and other income personally, and we assume a capital gains rate of 26.5% personally and a corporate tax rate of 50%, the value of the company is ultimately based on the underlying assets, not adjusted for deferred income taxes. So if we look at this, on Mr. A's death, there's going to be a gain of $7.3 million. We're going to have taxes owing at a 50% inclusion rate at 53%. We're going to look at about $1.9 million. And this is payable on his terminal tax return. So then what happens is A's children inherit the shares, and now they're looking to actually, take the money out of the corporation, wind up this thing. And when they do that, assuming that the investments have no longer appreciated in value, and we just continue with the same values at the time of death, this was a simplifying assumption. That's usually never the case. What ends up happening is we end up with a gain of about $646,000 on the sale of the investments in the corporation. This attracts tax at a 50% inclusion rate, at a 50% tax rate, about $161,000. We're going to have CDA. We have about $323,000 of CDA created from the capital gain we just created, and about $261,000 of CDA from opening. So we've got about $584,000 CDA, and we've got $358,000 of RDTOH. So basically, we have $7.3 million less the $161,000 of corporate tax plus the $358,000 of RDTOH. So we've got about $7.5 million that we have available to distribute. So in terms of the distribution, it's going to come out $7.5 million, but $584 is going to be a capital dividend, and $6.9 million is going to be taxable dividend, and that's going to attract tax at $3.2 million. So if we look at this, we layer on all the layers of tax. What ends up happening is we end up with $7.3 million of initial value, but with no planning. And again, none of your clients are going to be in the situation, because you're going to be partnering with firms like Fazari and Partners that know how to do some of these strategies. But basically, the gist of this is if you do no planning, you're looking at about $5 million of total taxes payable. We've eroded our estate value to about $2.3 million, and our total tax is ultimately going to be $2.3 million net after tax. So our net estate value is $2.3 million. So, your next question to me is, Hemal, how do we solve this problem? And some of you already know these strategies, and some of you may not know these strategies. But basically, in terms of an estate planner's toolkit, there's basically, two main tools. the first is the redemption and loss carryback planning. And what we're doing is with this, we're taking advantage of a special provision in the Act, 164 sub 6. And what that says is basically where we create a capital loss in the estate, what we're able to do is if we do this within 1 year of the individual passing away, one taxation year of the individual passing away, we're able to carry it back to the terminal tax return. The key to this one is timeliness. And the second aspect of this is pipeline planning. So pipeline planning is basically another strategy which involves incorporating a new co, transferring the shares of the existing corporation to the new co. And what we're doing is we're turning the ACB created at death into a note receivable. And by doing that, what we're able to do is we're able to unlock the equity created by the bump created by terminal tax liability. And then what often gets done where we have the appropriate assets is we can try to take advantage of an 881D bump. Again, I'm not going to get into the details of that, but just know that we could bump the underlying value of the investments within the corporate environment. And then lastly, what we can do is we could look at hybrid planning, which is a combination of basically redemption loss carryback and pipeline planning. So it kind of gets the best of both worlds. So if we look at it, we started off double tax, worst case scenario, 68.3%. In an ideal world, none of our clients should be in this situation. So in terms of the optionality based on this fact pattern for Mr. A, we're going to look at, doing a redemption loss carryback. And if we do that, what we're able to do is basically eliminate the capital gains tax at death. We're stuck with the corporate tax and the dividend tax. So we end up with a net estate value of $4.2 million and a tax rate of about 42%. If we do the pipeline and bump, we're able to get it down to 26.5% and a $5.4 million net estate value. And if we do the hybrid, we could actually get it down to 25.6% and close to about $5.45 million net estate value. At the end of the day, all of these are great options in terms of the redemption loss carryback. The benefit of that is it's very timely. You could do it within a year of the individual passing away. Pipeline and bump does take a little bit longer. It could take 2 to 5 years to potentially unlock everything and get your money out, but it ends up being the lowest tax rate in today's environment because capital gains rates are lower. So in terms of this redemption loss carryback, as I said, results in dividend tax treatment, use if we have CDA and RDTOH, and this is very time sensitive. We have to do it within one taxation year of the individual passing away, and we have to do this within the graduated rate of estate. In terms of the pipeline, we basically can unlock the ACB created at death, and we can use this if capital gains rates are lower than dividend rates, which is the case today. If we do have a change in tax rates, this can reduce the gap and basically eliminate the advantage the pipeline ultimately has. And often we try to combine this as part of an 881D bump plan. And then hybrid planning gets us the best of both worlds, where we are able to unlock favorable tax attributes like RDTOH and CDA, and also benefit from the pipeline and lower capital gains rates. So now your next question to me is Hemal, could life insurance do a little bit better? And my simple rule of thumb with this is you can do postmortem planning without any insurance. You could bake the cake. I call it what the planners do, the tax planners do, they can bake the cake. And what the insurance is ultimately icing on the cake. And what I mean by that is each of the results you'll see in the next couple of slides are going to improve tremendously when we add in life insurance. So it's kind of like, making that cake sweeter, right? And we, I don't know about you, but I like it when the cake tastes really sweet. So anyways, let's go into this. We're contemplating 6 different insurance solutions. Don't get caught up in the details of this. Working with somebody like, Tony and his team, you'll be able to, go through different options. But basically, there's 2 guaranteed options, which are universal life, 2 with investment risk. So the whole life at the 6.25% rate and whole life at 5.25 rate. And then what we're looking at doing is an immediate leveraged arrangement. And the key here is we have a loan rate of 5%, we're borrowing to invest at 4% or 7%, and we're going to look at what the results look like. So all in, bottom line, this is a confusing table, but what I want you to do is focus on the circled amounts, which is basically the net funds to the estate. With a balanced portfolio, we're looking at $5.4 million of net value. With any of the insurance solutions, we've basically improved our results on the low end to 2.3% on the guaranteed side, all the way up to 33% with the leveraged life insurance. And this is using a hybrid plan where we're basically doing a partial redemption to unlock the RDTOH and some of the CDA, and then we're doing pipeline planning for the rest. And basically what ends up happening is basically, we could have done this planning, done this without life insurance altogether, but by putting in life insurance, we've actually improved the results across the board for the client. And what's interesting is one of my earlier comments, if they do shut down pipeline planning, or if they do change the capital gains inclusion rates, redemption and loss carryback planning may be the only game on the street that would make sense. And at the end of the day, what ends up happening is if we look across the board with redemption loss carryback planning and life insurance specifically, we improve our results anywhere between 7.1% to 48.8%. So anyways, long story short, life insurance and postmortem planning generally increase net estate values. And this is the beauty of this planning is we're, the insurance world is not, competing against, the tax and estate planning world. This is where we've got synergies. It's like baking the cake, right? So, you guys bake the cake, we add the icing to the cake. And at the end of the day, what ends up happening is we can ultimately improve the results for the client. One of the things to look out for when we are putting an IFA in or immediate leveraging, what we want to do is we just want to be cognizant of the fact that we use our borrowed funds, and this is typical leverage investing. We want to basically invest in an asset that's earning a higher return than the rate of interest on the loan. So anyways, long story short, I've covered off a lot of content. I'm going to turn it over to Joe, but just as a synopsis, immediate leveraging is becoming a hot idea in our world, and you'll probably see more and more of these deals coming across your desk. And the other thing that you want to bear in mind is generally life insurance and postmortem planning work really, really well together. So with that, I'm going to turn it over to Joe to close out the presentation. So I'm going to stop sharing.
All right, thanks, Hemal, and thanks, Tony, for the great insights in your presentations. I feel there's a lot of useful information and strategies for us as tax practitioners to take back and implement with our clients. So thank you for that. I'm going to just share my screen here. All right, so I'm going to wrap up this morning's seminar with a discussion on probate planning. So in Ontario, probate, it's legally referred to as estate administration tax. But a lot of people call it probate, and so I'm going to use those terms interchangeably throughout the presentation. So normally on death, the authority of an executor arises immediately. However, in order for them to deal with the assets of the estate, they're going to need to obtain a grant of probate to sell or manage any of those assets. So probating the will is the procedure where the executor gets that authority, and it also assists in validating the will. So that process in Ontario, it's referred to as obtaining a certificate of appointment. And the thing to keep in mind is that once a will is submitted for probate, all of the assets governed by that will are subject to probate. So this creates obvious planning opportunities with the use of dual wills, which is one of the strategies I'll discuss. So as part of obtaining the grant of probate, there's the probate tax that needs to be paid. So there's no probate on the first $50,000 of value on an estate. But for estates that are worth more than $50,000, you're looking at a rate of roughly 1.5%. And these returns need to be filed within 90 days after obtaining the certificate of appointment. So there's a common perception, that paying probate or obtaining grant of probate is a bad thing. But and in some cases, it's possible to administer an estate without getting that grant. But there are some benefits to actually obtaining a grant of probate and paying the tax. So for example, Obtaining a grant of probate actually protects an executor from types of challenges or even exposure to liabilities. So, for example, by obtaining the grant of probate, they're basically confirming their authority to manage and deal with assets of the will. So in the event, let's say, the will is determined to be invalid at a later date or a subsequent will is discovered, the executor is generally going to be protected from any types of claims because they were operating under a will with a grant of probate. Another benefit is that obtaining the grant actually starts the clock for certain claims against an estate to expire. So if you never obtain a grant of probate, or many of our clients who probably act as executors, or us as professionals who may act as executors, if we never obtain that grant, that clock doesn't start to expire. So for example, dependent relief claims in Ontario expire 6 months from the grant date. So something to keep in mind when advising clients with respects to probate. So as I mentioned, it's not always mandatory to get a grant of probate, but with specific assets, it's going to be needed. So for example, if you're dealing with real property, for example, or any types of loans that are secured against real property, probate is generally going to be required for you to deal with that asset. Also, if there's no will, a grant of probate is going to be required as well. Also, if you're dealing with third parties such as banks or other financial institutions, they're not going to allow a transfer of property to the executor without a grant of probate, because they also have potential liabilities if they're dealing with someone who's not authorized to manage those assets. So probate's going to be not needed in those cases. If the estate is subject to any kind of litigation, it's going to need a grant of probate as well. And as I mentioned earlier, it helps to resolve any disputes over the validity of the will. So unless it's somehow later revoked, a probated will is going to presume to be valid. So authority is difficult to challenge. So here are just a few examples of some of the assets that would be subject to Ontario estate administration tax. We have real property, bank accounts, non-registered investment accounts, and then life insurance and registered accounts if the estate's named as a beneficiary and there's no other named beneficiary. So we'll run into a few planning examples of how that can be managed. It's important to note that any mortgages against real property are deducted from the fair market value when determining the probate to be paid. But keep in mind, there's no deduction for debts that aren't secured against real property. So if a client has an investment loan, for example, that won't get deducted from the fair market value of the non-registered account, for example. A few assets that aren't subject to probate, real property outside of Ontario isn't required to be probated, as well as CPP death benefits. These can be deposited into the estate account and not be subject to probate. Some of the planning we're going to discuss today, we'll look at shares of private corporations when dual wills are used, and also amounts passing outside of the estate. And here are just a few of the examples of some of the items that come into play, and we'll talk about some of this planning with the life insurance and jointly held property, as well as assets held in trust. So, and probate planning, it's an important part of the overall estate plan, but it can't be viewed in isolation on its own. It's got to be looked in conjunction with the overall estate plan and objective for the clients. And this is one of the biggest areas of estate planning where there's a lot of misconceptions and mistakes are made. So, with probate planning, given the rate is only 1.5%, the planning has to be practical. So a cost benefit analysis, is generally required for any type of planning you're looking to implement, right? So for example, we don't want to implement a plan that's going to save $15,000 of probate, but cost $15,000 of professional fees over the next 10 or 15 years. So you want to make sure you're being practical in plans that are being put together for clients. And also you want to make sure clients aren't engaging in bad planning. And this is often the case with probate planning. There's a lot of do-it-yourself planning that's done by by clients, and they can increase the cost of administering the estate, result in lost tax planning opportunities, and can also impact distributions to beneficiaries. And I'm going to provide a couple of examples here of some do-it-yourself planning that comes up quite often that impacts all three of these areas. And it's funny, with this example, I actually had a discussion yesterday with a client who called and did this exact same thing and thought it was a home run from a probate perspective, but they didn't consider some of the other adverse implications. So, for instance, we have two children that convinced their parents to transfer their principal residence and the rental property into joint names with right of survivorship. And this is one of the planning points you can do to avoid probate. But what are some of the implications of doing so? Well, off the hop, the principal residence exemption is now compromised because now there are multiple owners. So any future gain realized on the growth of the property is not going to be fully sheltered by the principal residence exemption on the deemed disposition on death. Furthermore, the children are presumably going to be in a higher tax bracket than the parents. So the rental income that's going to be earned, they're going to pick up their share. It's likely going to be taxed at a higher rate than it would have if the parents otherwise just picked up all of the income. There's also a deemed disposition on transfers into joint title. So it may not be a big deal for the principal residence exemption because it's going to be sheltered from tax, but with the rental property, the portion that's gifted to the children, it's going to result in prepayment of tax on the accrued gain at that point in time. Another thing with right of survivorship planning is that it can create a mismatch if there's an out of order death. So for example, if one of the children were to predecease the parent, when the parents pass away, the property is going to automatically pass to the surviving sibling. And the deceased child that passed away, their children won't inherit any part of the property, which may not be aligned with the parents' intentions. So although holding property with right of survivorship will get you out of probate, there's all these other adverse tax consequences or distribution consequences that often aren't considered by clients. And the same can be said with beneficiary designations. This is another example of a way to bypass probate, since the amount being paid out of a registered plan is going to bypass the estate. So we have an example here where again, two siblings convinced their mother to put her stock portfolio into joint names with right of survivorship in order to minimize probate. And the mother also designates her two children as beneficiaries of her RIF. And then her will provides that the residue of her estate is simply going to be divided equally between her two children. And there's a gift over to their children should they predecease her. In this example, Tony has no children and Mary has two adult daughters. So unfortunately, Mary and Anna die in a car accident. So the implications of the planning done by Anna is that, as the sole surviving designated beneficiary of the RIF, Tony's going to receive the full balance of the proceeds, and Mary's children will get nothing. Tony's also going to receive the stock portfolio as the sole surviving owner as well. And the only thing that's going to be split between Tony and his nieces is the share in the residue of the estate. So we can see here how the beneficiary designations, had an unintended consequence and probably disrupted the intended estate distributions that Anna would have probably liked to see. So, what she could have done differently is it's common to include what's called a hodgepodge clause in a will, which factors distributions that pass outside the estate to help even out distributions between beneficiaries. Anna could have also used variations of trusts, or she could have named her grandchildren as contingent beneficiaries. So naming contingent beneficiaries is a lot easier with adult beneficiaries, but if you're dealing with minor children, it becomes a bit more difficult. It's difficult to structure trust terms in a beneficiary designation like you can in a will. So something to keep in mind with the beneficiary designations. So generally, probate planning strategies look to do two things: reduce the value of the estate, of the value of assets that are going to be subject to probate, or have assets or amounts pass outside of the estate. So here are a few of the common strategies, and I'm going to run through them fairly quickly in the limited time I have left. But I'll start off with the dual will strategy, and this is probably the most common strategy for dealing with private company shares or assets that are held in trust for an individual. And the aim here is to isolate assets that require probate into a primary will and assets that do not into a secondary will. It's important to keep in mind that there's still only going to be one estate for tax purposes. So it's common in these cases to name the same executor to avoid conflicts in estate administration. And often assets in a secondary will can generally be non-liquid assets, so shares of private companies, for example. So there often comes up an issue is how's the estate going to fund the terminal taxes from assets of a secondary will? Well, it's common to see a crossover debt clause in the will, which basically allow for assets under one will to be used to pay for liabilities in the other. And this is often what we see with funds coming from the primary will to pay for the tax on the private company shares, for example. And lawyers will be careful to ensure that they're not revoking either one of the wills by including a revocation clause. Another planning probate strategy involves the use of a bare trustee. And this involves separating legal title from beneficial ownership. So the legal owner is merely going to hold title on behalf of the beneficial owner. This type of arrangement, it's recommended that it's supported with a declaration of trust. And it's common for a bare trustee to be a corporation, but individuals can also hold title to an asset as a bare trustee. So I'm going to go through some examples throughout the rest of the presentation of how this bare trustee planning can work in conjunction with some of the other planning techniques provided, but it's important to keep in mind that it does require dual wills for this to work, and that's because assets that are held in trust would be governed by the secondary will, which isn't going to be subject to probate. So the nice thing about using a bare trustee arrangement is that you don't have a deemed disposition for tax purposes as you would if you transferred an asset to a regular trust. The CRA has a long-standing position that bare trusts are ignored for income tax purposes, and so the transferor is considered to own is considered the owner of the property for all purposes of the Act. And this is crucial because the principal residence exemption won't be jeopardized if a client put their principal resident with the bare trust. And the same with land transfer tax. There's no land transfer tax on transfers to trust. There are additional compliance costs if a client chooses to use a nominee corporation. They're going to have to pay for incorporation and annual tax filings and filings with the ministry. It's important to keep in mind if a client is using a bare trustee corporation, not to record the asset on the books of the company, and if it's a rental property, for instance, not to record any of the income expenses on that property. So another planning technique to get out of probate is to have assets jointly held. And then there's normally two main types of co-ownership. There's joint tenants with right of survivorship and tenants in common without a right of survivorship. Joint tenants property passes outside the estate to the surviving joint owner. So that's how it'll bypass probate. Eventually, the entire value of the property is going to be included in the estate of the last to die joint owner, and it'll be distributed subject to the terms of their will. And so this is a simple and effective way to pass ownership, mainly between spouses without probate or income tax consequences because there's an automatic spousal rollover. To contrast this with tenants in common without a right of survivorship, in those cases, each owner is considered to have a partial ownership in the property. So if a joint owner were to pass away, the property automatically doesn't pass to any other surviving owners, and the individual's respective share will form part of its estate and be distributed under the terms of their will and likely subject to probate. So as we saw with the earlier example, there's a lot of issues with joint tenancy. As we saw, it can conflict with the distribution plans in a will. So, a couple may want each of their children to share in the property, but let's say they may have only added one child as a joint owner and not another one. And this can create disgruntled beneficiaries because, if some children are included and others aren't, they're not going to inherit any of the property. And so that may not align with the parents' actual intentions. But they often do these things quick as a means to just avoid probate. As we saw earlier, if there's an out of order death, certain family members can be disinherited if their parents pass, and they won't get any inheritance from their grandparents if property is held with the right of survivorship. The other issue with putting property into joint ownership is that you're actually exposing it to claims of creditors of all the joint owners, as well as any spousal claims should there be a breakdown of a marriage of any of the joint owners. So often not considered as well by clients when doing this type of planning. Again, as we saw with the rental property example, there's a deemed disposition on transfer into joint names, which can create a prepayment of tax. Again, maybe not a big deal if it's a principal residence, but definitely if it's an income earning property, it'll trigger a prepayment of tax. The principal residence exemption will also be compromised for the portion held by the joint tenants who don't ordinarily inhabit the home. So this is bad planning from a principal residence and tax perspective, since the probate savings aren't going to outweigh the tax cost of doing this type of planning. And lastly, it's important to document intention when putting title in joint tenancy. In Ontario, there's a presumption of resulting trust on gratuitous transfers. And that means, unless there's a clear support that there's intention to gift and transfer a portion of the property to the other joint tenants, they may be simply deemed to be holding their interest in trust for the estate of the transferor, which brings the asset back into it. So for genuine gifts, it's important for this to be documented with a deed of gift or some other form of document to support it. So to avoid a lot of the pitfalls I just discussed with joint tenancy, it can be combined with the bare trustee strategy I discussed earlier. So the way to accomplish this is that a parent would transfer legal title to include an adult child as a joint tenant, but then that child will sign a declaration of trust where they confirm that they're holding the asset in trust for their parent. And then the asset will still form part of the parent's estate and be distributed in accordance with the terms of their will. If there's only one will, this planning won't work, because as I mentioned earlier at the beginning of the presentation, once a will is submitted for probate, any assets governed by that will, including assets held in trust, are subject to probate. So a secondary will is required for this planning to work, and the asset being held in trust by the child will form part of the secondary will. And again, no income tax consequences in doing so, because there's no deemed disposition, since it's being transferred, even though it's being transferred into joint ownership, it's being done in trust, so there's no deemed disposition. And alternatively, the bare trust, the corporation can be used in place of the adult child if the parent decides to do so. I'm going to move on to another planning opportunity, and that's with beneficiary designations with respects to life insurance and registered plans. So normally these proceeds are paid tax-free and they pass outside the estate, as long as a beneficiary is named in the contract other than the estate. It's recommended to name alternate beneficiaries in case the first beneficiary dies before the insured. And if there is no alternate, and the first beneficiary passes away, the estate becomes the default beneficiary. You can also designate a trustee of a life insurance trust as a beneficiary to accomplish this. And what's good about this type of planning is that the funds are accessible immediately and they're not trapped during the administration period of the estate. There's also creditor protection. The proceeds don't form part of the estate, so it won't be subject to any creditors of the deceased. And from an executor fees perspective, it actually reduces the fees because that value isn't formed as part of the estate, so it won't be included or considered when determining the executor fees. one thing to keep in mind, that care has to be taken to make sure that those proceeds are kept outside of the estate. Another concept that a lot of clients have a hard time grasping is that, the proceeds of a life insurance policy, they actually belong to that named beneficiary, not the estate. So a problem that arises often is, well, the estate needs the funds to pay the terminal taxes. And the solution often is, okay, well, the beneficiary is simply just going to use the life insurance proceeds to pay the terminal tax on behalf of the estate. And that does create adverse tax consequences because they can disqualify the estate and the trust as a testamentary trust. So the CRA's position is that that payment of the taxes by the beneficiary is considered a contribution to the estate, and it'll lose its testamentary trust status. So why is that important? Well, as Hemal mentioned earlier, if you're looking to do 164.6 loss carryback planning, you've now tainted your ability to do that, because in order to qualify as a graduated rate estate, it must be a testamentary trust. And if the beneficiary pays the taxes on behalf of the estate, you've kind of lost this planning opportunity. So, you're saving 1.5% probate, but now you've cost the estate an enormous amount of tax. So it's always important to make sure beneficiary designations are carefully considered in context, and in conjunction with the postmortem tax plan, because we can see how it can quickly go offside. So to designate or not to designate, it depends. An analysis is required of the estate's terminal tax liability and then the funding sources available. So if there are sufficient assets to pay the tax, then maybe you name a beneficiary and save the probate. But you'll need to run through that analysis for your clients. But if possible, use corporate-owned life insurance, since that won't be subject to probate, since the shares will be subject to the terms of the secondary will. The same type of planning applies for registered plans. These proceeds pass outside the estate as long as the beneficiary is named. The beneficiary does receive the funds without tax withholding, but the estate bears the tax burden. So this can have unintended consequences as well from a tax perspective. The beneficiary is going to get a huge windfall, and that can deplete the estate of its assets, since it's going to have to fund the taxes it has to pay on death. Often executors are quick to distribute funds from the estate before obtaining a clearance certificates in these cases, because they don't think there's an issue. So if there are unpaid taxes and they've distributed the assets, it could increase the executor's liability. And if the estate doesn't pay the tax, the CRA does have the right to collect from the beneficiary, so they're not out of the woods. Another planning opportunity is, allows a parent to convert cash in its bank account that would otherwise be subject to probate, and basically convert that into a loan, either to an adult child or a prescribed rate loan to a trust for minor children. And the benefit of doing this is that the loan receivable will be included as an asset under the secondary estate and wouldn't be subject to probate. So it combines probate planning savings with income splitting opportunities using a prescribed rate loan. Another probate planning opportunity involves the use of inter-vivos trusts. And this is mainly suited for individuals over 65. They get a tax-free rollover into the trust as long as they're entitled to all of the income and capital during their lifetime. And since the assets bypass the estate, they won't be subject to probate, but there's still a deemed disposition of the trust assets when the settler dies. There's really no income tax benefit to using these types of trusts. They're mainly suited for probate or incapacity planning. And that's just because the trusts can be subject to top marginal rates. These trusts are useful for principal residence exemption planning. So these are one of the few trusts that are eligible to claim the exemption. And it also gives you access to 164.6 loss carryback planning, but it doesn't fall under this provision. You would do the loss carryback under the normal loss carryback provisions. These types of trusts generally not recommended, to hold registered plans or qualified small business shares that can be sheltered with the capital gains exemptions or any U.S. real property. And these types of trusts are obviously more expensive and complex than some of the other strategies we kind of went through already. So, you always got to factor in the additional implementation costs, legal and accounting fees. So, unless incapacity planning is an objective, there's simpler strategies that we discussed, like the bare trustee planning, that can achieve the same probate planning savings for clients. So another way to reduce value of an estate is to basically gift assets during an individual's lifetime. And since they won't own the asset on death, there'll be no probate. It's generally not a good strategy and not recommended. The donor is going to lose control of the property. It's going to be exposed to creditors or possible family law claims of the child that it's being gifted to. And then down the road, it's going to be subject to the terms of the will of the recipient and not the donor. So it may not align with the ultimate owner's distribution intention. And there's also going to be a deemed disposition at fair value, which creates a tax liability for the donor. And then also it's going to diminish the value of an estate. So if that asset is actually needed to, let's say, fund taxes or fund legacies to any of the beneficiaries, it's generally not a good idea to donate property during lifetime. So another strategy, and it's not too common, but it is out there, is that, if you're looking to match debt with an asset, you can actually use a corporation to own legal and beneficial ownership of an asset. And this is mainly because we talked about earlier, real estate, you can deduct the value of a mortgage against the property, but it doesn't work the same way for investments, let's say at a portfolio loan. So an individual, let's say with $1 million portfolio and a $300,000 investment loan, won't get the $300,000 deduction if they kept that asset in their personal name. But if they had it corporate owned, and assuming the shares were worth, 700,000, it's basically the value of the portfolio less the loan, you would only be subject to probate on the 700,000, and that's assuming they're not using a dual will strategy. So it does provide some benefit, but there are many pitfalls with using it just to save on the probate. There's the double tax considerations on the accrued gains if assets are transferred in with accrued gains. Even though it can be mitigated with post-mortem planning, it adds unnecessary complexity to an estate. You got to file rollover forms, and the CRA is going to be aware of it. And it doesn't work for real property, or it does, but it's just not recommended because the bare trust planning achieves the same savings and results. And it's mainly used for investment portfolios. And this is because, putting an investment portfolio in bare trust, generally the company, the banking and institutions have difficulty with reporting. So there's a mismatch between the bank's reporting slips that are issued to the bare trust corporation and the individual who has to ultimately pick them up in income. So they generally struggle with that type of arrangement. So that's why the use of corporations is considered as an alternative. So is probate planning needed? So, you always got to outweigh the costs versus the probate savings. Depends on the value of the estate. What's the expected probate liability? What's this going to cost your clients in terms of compliance and filings, and what's the cost to set this thing up? But overall, you want to make sure it's done in conjunction with the overall estate plan and the postmortem tax plan, because as we saw throughout the presentation, there are many pitfalls and issues that can arise by simply just trying to save 1.5%. You can create more tax costs elsewhere. So probate planning, generally, it's always needed, but it's not going to be your main objective, but it's going to be part of the overall estate plan. So thank you everyone for your time. If there's any questions, fielding. I don't think there's any questions in the chat at this time. So I think, we went 10 minutes over, but thank you for everyone for attending today. And there was a lot of great information and strategies presented today. So if there is a client that science with their insurance and postmortem planning.
I just want to thank all the presenters today. You guys are fantastic, provided great information, and I'm sure everyone took something away from this presentation. If anyone on the in the seminar has any questions for any of the presenters, just reach out to Joan and she can provide you with their contact information. Otherwise, thank you everyone for attending, and I hope you all have a great day.